And I generally don't comment on valuations, except at points in time where they seem so off kilter, out of whack that they could become a macroeconomic issue, and that's this period in time.
Mark Zandi returns to the show. He is the chief economist at Moody's. We'll be talking about his outlook for economic growth, markets, equities, and bonds, and inflation. Welcome back to the show. Good to see you, Mark.
David, it's good to be with you. Thanks for the opportunity.
The Psalm rule was triggered last time we spoke a couple months ago. We'll talk about your outlook on the economic growth landscape, whether or not we're getting an inflationary impulse in 2025, whether or not we're getting a recession in 2025. These answers, hopefully, we can discuss today. Take a look at some of my or some news coming out of the Financial Times earlier today. Top Federal Reserve official warns progress on taming U.S. inflation may be stalling. This is from Christopher Waller, governor of the policy setting FOMC. He said that there's still elevated borrowing costs. We're curbing demand across the world's biggest economy, the U.S. He noted that if the data we receive between today and the next meeting surprises in a way that suggests our forecasts of a slowing inflation and a moderating but still solid economy are wrong, then I will be supportive of holding the policy rate unchanged in December. Do you support that view that the Fed should and possibly could keep rates unchanged at the next meeting?
I think it's a possibility. I think it's a close call, but I think at the end of the day, inflation is very close to the Federal Reserve's target, and all the trend lines here look good. The only difference between current inflation and the Fed's target is the growth in the cost of home ownership, the owner's equivalent rent. And I think that's a very lagged, vexed measure. And you exclude that, we're there, and that's where we're headed. So I think ultimately they'll cut in December, but I don't say that with strong confidence. I think it will be a close call.
Do you think that they're too early to cut, or they have been too early to cut this year?
No, I don't. I mean, I think they've achieved their mandate, which is full employment, consistent with a 4% unemployment rate. And as I said, I think inflation is very consistent with their target, and if not, they're headed in that direction. So if that's the case, then they should normalize the federal funds rate to be consistent with the so-called equilibrium rate, that rate at which policy is neither supporting or restraining growth. That's a tough know what that is exactly, but I know it's not 4.75%, certainly not 5.5% where the funds rate peaked. So I think they should have cut rates, and they should continue to cut rates until we're back down closer to 4%, which is probably the highest estimate of the full employment unemployment rate at this point.
Okay. Now, Mark, let's talk about your outlook overall for economic growth in 2025. As I alluded to earlier in the introduction, when we spoke a couple of months ago, the unemployment rate ticked up to such an extent that you could argue the recession already happened, but obviously it wasn't declared officially. Are we still on track to see some sort of economic slowdown? Is a recession basically in the cards for 2025?
No, I think the Psalm rule was not useful this go around, in significant part because the run up in unemployment was due to labor supply, not labor demand. I mean, historically, it was labor demand got hit, you got layoffs, and thus unemployment rose, and that was consistent with recession. This go around, it was mostly a surge in immigration added to the labor force that caused unemployment to notch a little bit higher, and it had anything to do with demand. And therefore, the Psalm rule didn't work, and it's not working now. And I think the economy is on solid ground. We got big policy changes dead ahead with the new president and new Congress. So I think that will pose some threats and challenges. But there'd have to be a pretty egregious policy error at this point to undermine the economy. I think the fundamentals are good.
What do you expect to happen for earnings next year?
Earnings should be fine. If the economy performs as I expect, and even if margins stay where they are, I don't expect margins to widen here because they're already very wide by historical standards. And when I say that, I'm thinking about economy-wide earnings, economy-wide profit margins. So that means earnings will grow at the rate of sales. And if you told nominal sales, so if you told me the economy is going to grow 2-3% real, 2% inflation, that says, sales are going to grow 4, 5, 6%. And that should be what earnings grow in the coming year.
You mentioned to me offline that things are looking frothy on the valuations front. Are you referring to the equities markets in particular?
Across the board, it feels like asset prices are getting ahead of themselves. I mean, as you can tell, I'm pretty sanguine about the economy and corporate earnings, but I think markets have gotten ahead of all of that. And take a look at equity prices and price earnings multiples, look at corporate bond spreads. They're paper thin by any historical standard. Look at crypto prices, look at gold prices, look at the value of single family homes, uh, pretty much across the board. I guess the only exception would be commercial real estate values. They're down, they've corrected. But well, outside of that, I think asset values are feeling on the high side, and they continue to march higher. And I think getting increasingly disconnected from even the good fundamentals, and that does open up the asset markets, financial markets to a sell off a correction. If things don't stick exactly to script. And again, we got a lot of policy changes coming our way, and not sticking to script would probably be an apt description of what's coming.
What is coming? Either a correction or just more frothy valuations.
It's my baseline forecast down the middle of the distribution would say, markets kind of go sideways here and let fundamentals catch up to prices, and valuations normalize, or at least don't become even more lofty. But I think there is a growing risk threat that these lofty valuations and prices are will unravel in a correction and a sustained decline in price. And I do worry about that as a kind of a risk scenario. It's not the most likely baseline scenario, but it's a reasonable scenario to entertain. And with each passing day that stock prices continue to rise strongly, or credit spreads in the bond market, corporate credit spreads in the bond market narrow, the more worried I get about that possibility, the greater the risk that that we suffer a correction that will have significant macroeconomic implications.
Let's take a look at Trump's policies, especially regarding fiscal policies, and then we can examine some of his trade policies and how they may impact the economy. On the fiscal side, tax cuts, will that boost margins going forward?
Yeah, that's one reason why stock prices are up. I think investors are discounting a tax cut, a corporate tax cut. President Trump on the campaign trail talked about going from 21%, which is where the current tax rate is, to something closer to 15. He's talked about 20. So, hard to know exactly where he's going to land. There's other corporate tax cuts that will also be on the table and make it through the legislative process around R&D, accelerated depreciation, bonus depreciation. So, yeah, I think businesses will get some form of tax break, and that's one reason why stock prices are up. Why we've seen equity prices rally here in the wake of when it became increasingly clear that Trump was going to win the election, and actually did win the election.
What about the criticism that a lot of the tax cuts aren't going to be implemented right away? It'll still take some time for these to be realized, and so companies still face the immediate threat of tariffs, which may be profit margin reducing, not expanding.
Yeah, I think you're right. The tax cuts probably don't get implemented until the start of 2026. I mean, there is a legislative process. Tax cuts have to be passed into law, and tax cutting legislation is always complicated, a lot of moving parts, a lot of stakeholders, and so it's going to take a bit of time. And then I don't think they'll want to cut taxes, for logistical reasons until the start of 2026. But I think investors obviously are looking forward, and they're discounting that. I do think the tariffs are a potential problem for the economy and earnings, but it depends on exactly what those tariffs will be. I mean, President Trump on the campaign trail talked about a 10% across the board tariff, 20% at one point in time, 100% on certain products and countries, higher than that for certain companies. If that were the case, then that's the prescription for a recession. We would see a major correction, decline in equity prices and asset values more broadly. That would be a real problem. I just don't think that's going to happen. I don't think the markets think that's going to happen. They think it's going to be something much more benign, and thus the rally in stock prices.
That's a fair point. We're speaking today on Monday, the 2nd of December. The S&P is above 6,000 points again. And just over the weekend, Donald Trump posted on his social media network, Truth Social, that if the BRICS countries were to abandon the dollar and work on developing their own joint BRICS currency, Trump would look into implementing a 100% tariff across the board on those BRICS nations. I don't think the markets are discounting that at all today. But what are your thoughts on that? Is that likely to happen?
No, I don't think so. I mean, that would be very disruptive and again, the fodder for a major correction in stock prices and asset values broadly and an economic recession. I think that's more uh, performance policy, performative policy. He's trying to make a point, create a little bit of drama, not something that's unusual, based on his first term. So I don't view it as something he will actually do. Because if he did, it would be highly disruptive, and I don't think he wants to do that.
You mentioned also that on another channel that you think that there is some room or some place for broad-based tariffs across the board. What do you mean by that?
No, I don't. I think there is room for strategically placed tariffs.
Oh, you don't
So
think there is a real? Yeah, my
no,
apologies. Yeah, you don't think there
no.
is a role for broad-based tariffs, but on particular sectors, yes.
Well, yeah, I mean, like Biden imposed tariffs on $18 billion worth of imports from China, EVs, batteries, those kinds of things, uh, in an effort to make a point and make clear that China's not playing fair. And in the current context where there's no other way to adjudicate differences around tariffs or any other kind of trade or economic policy, that's the only tool you have. Okay, fair enough. But that's 18 billion, that's not 3.4 trillion. That would be across the board tariffs. So that's a whole different, as they say, kettle of fish.
When Trump announced higher tariffs on Canada and Mexico last week, the Canadian dollar fell a bit, the Mexican peso fell a bit. How do you anticipate the US dollar to react to potentially retaliatory tariffs from some of the American trading partners? Could we see capital outflows out of the US? Could we see bond yields fall? Could we see the dollar fall in response?
Well, no, I think if the President Trump does go down the tariff path in a meaningful way, that will lead to a stronger dollar. That will, put a lot of pressure on the countries that are facing those higher tariffs. Mexico and Canada, I think, if memory serves, 15 to 20% of their GDP is tied up in exports to the US. So if you're imposing, significant tariffs on that, that's going to push those economies underwater, and that puts downward pressure on their currencies. You get capital flight into the U.S. So I expect a stronger dollar. Those tariffs will result in more inflation, and that means higher bond yields. So I think in general you'll get higher bond yields, higher interest rates, and a higher value, higher inflation, and higher value of the dollar.
Okay. Turning back to financial markets, you have this interesting tweet that I like to show people. Financial markets are increasingly off kilter. In the blue line, you have the high yield corporate spread, and the green line, you have the fixed mortgage rate spread, currently below the high yield spread. What is this chart showing, Mark?
Yeah, pretty cool, huh? That's
Yeah.
pretty. That's the. I mean,
And it's now converging.
well, it's actually last I looked when I did this a week ago or so, mortgage spreads were above high
Interesting.
yield corporate spreads for the first time ever. I mean, I've got data back into the 90s, not even close. And it just to my point about markets and asset markets in general, they're overvalued, bordering on frothy, speculative, a lot of weird things going on in these markets. This is just another example, where the time space continuum has gotten bent in a pretty significant way. I don't mean to overstate the case here. Lots of things going on,
Sure.
both in terms of high yield corporate spreads and mortgage spreads, but nonetheless, it does highlight, that things are off kilter. And generally, when things are off kilter in the financial markets, things correct. There's so-called mean reversion, and that this would be a good case in point. We're going to get some mean reversion at some point here in the not too distant future.
Mean reversion to the downside or the upside if some certain assets have not caught up yet.
Well, I think it's generally lower asset prices, so that means
Hmm.
higher. The corporate bond yield will rise. Case of the mortgage rate, that's pretty elevated. I don't know if that's going to change much here, given the prepayment risk in the mortgage securities, given prospects, given the inverted yield curve.
Yeah.
The other thing that's going on is, I think, investors are beginning to discount the possibility of so-called GSE reform. This is getting Fannie Mae and Freddie Mac, the big mortgage giants, out of conservatorship. And if they do that, that means that there's going to be more credit risk there, and so investors are starting to discount that and pricing that in, and that's why mortgage rates are high relative to treasury. One reason why mortgage rates are high relative to treasury yields. So there's a lot of different things going on here. But I think in general, mean reversion to me in a highly valued frothy market means lower prices, a correction, a sustained decline in prices.
Okay. On that note, do you think that the bond markets right now have are a little bit frothy as well? Take a look at the 10-year yield. I have here a chart showing the U.S. equity index, the S&P 500 index, versus the 10-year yield. Now, obviously, no direct correlation over the last year or so, although we are starting to see this trend of higher equities prices with lower yields, which you
Yeah.
may expect. Um, it's kind of strange. Usually they move in the same direction, but I'll let you comment on that.
Well, that's my point. This has happened all in the last couple of months, this kind of divergence. Yeah, long-term yields have risen.
Hmm.
I think in significant part because investors are anticipating inflation and inflation uncertainty and larger budget deficits. That's all getting embedded in the higher 10-year yield. And stock prices have continued to rocket higher because of lower corporate tax rates, maybe some deregulation, in financial services, utilities, and technology, and less antitrust. So these things are diverging, but those that can't continue. I mean, that makes no sense when long-term yields are rising and asset prices are rising at the same time. So that's again goes to my point. Things are, I'm using the word off kilter, off base. It doesn't feel right, and thus my growing angst about potential for a market correction, an asset price correction, writ large here in the not too distant future.
Do you think that the bond market is pricing in perhaps lower inflation?
No, because if you go decompose the 10-year treasury yield, you can see that inflation expectations, like for example, go look at 5-year break evens.
Yeah,
They're up, 40, 50. Last I looked, I haven't looked in the last, few days,
right.
but they're up 40, 50 basis points. So about half the increase in 10-year yields is related to higher inflation expectations, if you decompose it.
Yeah. So what do these frothy valuations mean for a longer term investor? I've heard the argument that if you were to hold a 5 or even 10-year holding time period, you may consider alternatives to equities because with higher valuations mean inevitably lower returns over the longer term horizon. Does that make a lot of sense to you?
Yeah, I mean, I think as an investor, the most obvious thing is you shouldn't count on getting the returns going forward that you've gotten in the recent past. I mean, stock prices are up, what, on the S&P 50, 60% since just before the pandemic over the last 5 years. That's pretty significant increase in stock prices. I mean, a kind of out of bounds increase. So first, most obvious thing is don't count on that. That's not happening. It's going to be at best kind of flattish up a little bit, over the next 3, 5 years. Second thing is, you might want to be, I mean, if you're an active investor, and most people shouldn't be, but if you are an active investor, you might want to start thinking about, valuation very carefully in the context of your portfolio. And here I'm a little out of my remit. I am an economist. I play, market strategist
Yeah.
on podcasts. So I don't want people to take, to take this completely at face value. And I generally don't comment on valuations, except at points in time where they seem so off kilter, out of whack that they could become a macroeconomic issue, and that's this period in time.
I think this chart summarizes what you just said. Corporate bond investors are overly optimistic. You tweeted about this as well recently. Now, when we talk about valuations, things could go up in value for a host of different reasons. Are they at all disconnected, these valuations disconnected with fundamental economic growth currently?
No, I wouldn't say they're disconnected because the fundamentals are good, right? Remember what I said in the
Yeah.
beginning. Business are making a lot of money. They got a lot of cash. I mean, there's good credit risk is low, so I would expect the spreads here to be thin. It's just that they are paper thin, meaning I think if you go back, the only other point in time where spreads were thinner was right before the financial crisis in 2007. So the fundamentals are good. It's just that the markets are taking them well beyond the fundamentals. They're discounting that nothing is going to go wrong here at all. And again, I just that just is very unlikely, and particularly in the context of the policy changes that are coming under President Trump and the Republican Congress.
Well,
And there are
which
big policy changes coming.
Which policy changes could trigger a reversal or mean reversion?
Well, I'm no fan of broad-based tariffs. That's a good example.
Okay, there's
If
one.
it's on the margin, no big deal, but if it's truly broad-based, that's a big deal. I worry about mass deportation. If it's 50,000 immigrants, undocumented immigrants that are deported, maybe that's not great, but it's not a big deal. If it's 500,000, that's a deal. That's a big deal, and that create all kinds of dislocation.
How would that impact the economy?
two two key ways. One is labor supply. I mean, the U.S. relies, like Canada, very heavily on immigrant labor. And if you're asking people to leave the country and others are deporting because of the pressures they're under and employers are under, that just and we're at full employment, a 4% unemployment rate. That means labor markets are going to get red hot again. Wage growth is going to accelerate. Inflationary pressure is going to develop, and the Fed can't cut interest rates. So it's labor supply, and it's really in some key industries where immigrant labor is critical, like in the construction trades. Almost a third of the workers are immigrant workers. Not all are undocumented, but many are. And if you ask those folks to leave, homes are not going to get built. It's going to exacerbate the affordable housing shortage, and it goes right back to inflation because, as I said earlier, the key reason why inflation today is different than the Fed's target is the cost of home ownership. That goes to the ability to, if you can't build, the cost of ownership is going to go up, not down. And that just makes it even more difficult for the Fed to execute on rate cuts.
Let's talk about wages for just a minute in the job market. So I'm seeing different metrics of how you measure the standard of living. One metric is real wages, so inflation adjusted wages. That's been trending up recently. If you take a look at data from the St. Louis Fed, for example, wages continue to outpace inflation. Is that a trend that you're confident in seeing continuing into 2025 beyond?
That goes back to my kind of sanguine perspective, and the economy is in a pretty good spot. I mean, people's wages are rising faster than the rate of inflation, and that's been the case now for almost 2 years across the wage distribution. And, as long as that continues, hard to imagine, consumers pulling back and consumers continue to do their thing and spend. It's hard to imagine the economy going into a recession. So that's a good fundamental reason to be optimistic, about the economy. And that's why the baseline, most likely scenario, is we kind of navigate through this, reasonably well. Markets don't correct; they just kind of go sideways here for a while and let the fundamentals catch up to the valuations.
I see this chart being brought up several times as a counter argument to consumer strength. This is credit card debt in nominal terms reaching new all-time highs. The argument here that I've heard from other people and comments on the internet is that you don't need to use your credit card if you have the ability and the propensity to actually spend, right? So they're borrowing out of necessity, not because they have money. I don't know how you
No,
interpret this.
that's wrong.
Okay,
This includes both people who borrow and people who revolve. So, like me, I run up my credit card because I'm not using cash.
sure.
I pay it off every month, but that balance goes into this data. So this reflects both using cards as a debt vehicle and a transaction vehicle. And a lot of this is just transactions. And especially in a world of high inflation, the value of what you're buying and using your card for will rise, and that's reflected in here. If you took a look at this relative to income, disposable income, after-tax income, you get a much more benign picture. And go look at it relative to debt service, the percent of income that's going to servicing debt.
That's right.
It's very low and rock solid low. Households did a great job of locking in the previous low rates. Now, this does highlight a stress point in the economy, but it's on the margin, and that's lower income households who did borrow against their credit cards when inflation was raging back a couple 3 years ago, and they're struggling. You can see that in delinquency rates. But even there, that's starting to right itself. Credit card receivables are no longer rising very quickly, and it looks like credit card delinquency rates have peaked and are going to start to come in here relatively soon.
How are you interpreting this chart? Quits rate, total non-farm, it's gone down. It peaked around the pandemic, and then started coming down after 2022. One way to interpret this is that people are not confident in finding a better job, and so therefore they're quitting in fewer or less frequency. I don't know how you would interpret that.
Yeah, I'm not exercised about it. I mean, it's
Okay.
down in part because people aren't hiring.
Yeah,
People aren't quitting, they aren't hiring. It's kind of the flip of what was going on several years ago when everyone was quitting their job and hiring rates were very high.
sure.
The bottom line is, if you look at the last data point, it's pretty consistent with this long run average, which is the economy at full employment. And I think that's kind of this just another signal. But that decline, if it were to continue, would be a worrisome sign, and worrisome in the sense that the economy, the labor market is starting to weaken, as demand is becoming a problem, and the Fed, the Fed would have more impetus to cut interest rates. So I think it's an important indicator, but right now, to me, it's signaling that things are roughly where they should be.
Okay. Scott Bessent was appointed Treasury Secretary. How do you feel about his 3-3-3 policy, 3% of debt or deficit to GDP, rather 3% GDP growth, 3 million barrels of oil produced a day? Yeah.
Well, let me preface it by saying I think he's a very reasonable person, well qualified, competent. He's a markets person, so I think that'll be quite important if we do get that correction I've been talking about. The 3-3-3 policy, 3% growth, but yeah, bring it on. And we've been getting it, right? I mean, but that
Sure.
requires strong labor force growth. It's not consistent with immigrant deportation, just the opposite, and strong productivity growth, and that's not consistent with higher long-term interest rates. So, we're getting 3% now. I worry that it's going to be more difficult under the economic policies that are being espoused under by President Trump to get there. 3% deficit to GDP. Yeah, bring it on. I'm all for it. I don't think you can get there with deficit finance tax cuts,
Is
though.
that contradictory to point number two, 3% GDP growth?
It makes it more difficult, right? Because that means you've got to either raise taxes or cut spending, and those two things make it much more difficult. Right now, fiscal policy is neutral with respect to the economy. We're
Yeah.
getting 3% growth with stable deficits right now. They're high, they're wide, they're not good, but they're stable. If you bring those in, at least initially, that's going to be problematic, but it's going to be tough for the economy to overcome that. So that's an issue. 3 million barrels, I don't understand that at all. The U.S. is producing 13.5 million barrels a day. It's a record high. It's oil prices are low. I think if the U.S. and I don't know how they would do that. I mean, what do they get? What policy would actually get oil companies, frackers to put more rigs into the ground when they know oil prices are going to remain as low as they are? It's just not happening. So that one I just think I don't understand why that's a goal, other than President Trump talked about that on the campaign trail.
Yeah, just to clarify what I said, additional 3 million barrels a day from what it currently is.
Yeah.
So
So
it's,
16.5 million. That's
yeah.
like, there's no way, the oil industry is going to do that. It makes no sense when oil is already sitting at $70 a barrel.
Well, okay. So let's just focus on the two first main points. 3% additional growth or 3% real GDP growth, rather. Does that come from tax cuts alone? Is the assumption here that tax cuts will stimulate the economy, thus reducing the need for government spending to stimulate growth? And that's where the deficit reduction.
Well, I think the logic that's being put forward is, yeah, deficit finance tax cuts will stimulate economic growth and ultimately pay for themselves. This is the old supply side saw. Of course, that never happens. We've been down this path many times, so that's not going to work. So if that's and I'm putting words in people's mouths, and maybe they have a different logic, but that's kind of my take on it. So I just don't see it. I don't understand it.
Can we assume that some of the tax reductions can be offset by tariffs, meaning tariffs can provide the revenues lost or not gained, not earned through income taxes? Would that work?
Yeah, I mean, it would help, but it's not going to solve the deficit problem, because if you tax something, people buy less of it, so you're going to generate less revenue. And if you impose very high tariffs, you will push the economy into recession. You will cause the stock market decline, and the damage that will do will cost revenue and cause spending to rise and cause deficits to rise, not fall. So, I don't think tariffs is the way to address the nation's long-term budget situation.
Okay. So finally, let's close off on your market outlook. Any particular asset classes that you're most bullish on?
Yeah, as you can tell, I'm cautious about everything.
Yeah.
Everything feels a little overdone to me, at this point. So I think caution is the word. I mean, there's some classes I'm more nervous about than others. I mean, I just don't understand crypto, Bitcoin at, 100,000. I just don't think that's going to work out in the long run. Equity prices do seem stretched to me, the corporate bond spreads as well. So yeah, everything feels lofty. So it's hard for me to identify, other than cash, where you can get, I guess, 4 or 5% on a money market account, or four and a quarter, 4.3% on a 10-year treasury yield, which is not bad. I think it's pretty t tough to identify an asset class where I'd be enthusiastic at this point in time.
What about the housing market? A lot of analysts I've spoken to have predicted that mortgage rates could come down a little bit from current levels. If you continue this downward trend, do you expect transaction volume to pick up?
I do. That's a tough one, right? When rates decline, that obviously will lift demand, which would lift prices. But my sense is it will actually unlock supply because you've got a lot of folks that are locked in from the low rates that were prevailed back when they before during the pandemic when they refied into those lower rates. So if you get lower rates, and also you got a lot of homeowners out there that have been in their homes for a long time, and those homes no longer are suited to their demographic need. So this I would call it pent up life. They have kids now. Had a job change. They had death or divorce. The home they're in now is not suited. So you combination of lower rates and pent up life. I think you get more supply than demand, and then that will put downward pressure on prices. But that's one of those things again where I say that with less confidence because that there's a lot of moving parts there.
Well, you've studied the subprime housing crisis quite clearly. You've written books about this topic. I think one of them is called Financial Shock, a 360-degree look at the subprime mortgage implosion. Frothiness in the housing market, anything that looks similar now to, let's say, 2007. If you'd overlay the current Case-Shiller housing price index, for example, it looks awfully like the period leading up to 2007.
No, I'm not worried. I mean, a bunch of reasons. I mean, here you've got a very severe shortage of homes, physical shortage. Back then, you had a massive oversupply of homes. The home ownership vacancy rate was at a record high. Now it's at a record low. And also, the mortgage market's very different today, right? Because of the reforms made after the financial crisis. So, the mortgages are 30-year plain vanilla mortgages, with various restrictions on who can get those loans. So it's just a whole different ball game. It's not comparable.
Okay. I'm going to end on the title of your book, How to Avoid a Financial Crisis, or the Next Financial Crisis. So that is a good question in itself. What could the next financial crisis look like? And what could we do to avoid this crisis? This is the subject of your book called How to Avoid.
Yeah, well, that's a pretty deep question.
Yeah.
I do uh, worry about these valuations in markets, and particularly, what's going on in the bond market, the Treasury bond market. It feels very fragile to me in that the market is dominated by broker dealers who have not expanded their balance sheets consistent with the amount of debt outstanding, which has been quite considerable for lots of different reasons. So the trading is getting very choppy, a lot of volatility in yields, again, going back to those mortgage rates. I do worry at some point the market will get dislocated. And then you also have the Fed exiting out of that market. You've got central banks like the Chinese exiting out for other reasons. Japanese investors are becoming more cautious because they can get a yield on their bonds, the JGBs.
Yes.
And so hedge funds are coming into the void, and obviously they're very price sensitive. So I can keep on going, but the point is I wouldn't be surprised if we had some major significant dislocation in financial markets and more specifically in the bond market here, over the next 6, 12, 18 months. Again, it's not a baseline because it's hard to put that into a baseline, but it's something I certainly worry about and, watching very carefully.
Would the Fed respond to such a dislocation, or are they only concerned about the unemployment rate and inflation?
No, they would respond. Just it's a question of can they respond quickly enough and patch things up like they did with the banking crisis back over a year ago. As that's the Silicon Valley Bank failure. They stepped in, set up a credit facility, and the FDIC guaranteed the deposits of all those that were insured below or above the deposit limit. So they could step in, but if it gets into the corporate market, if it starts causing stock prices to decline, if crypto is falling, if you get this widespread sell-off in asset markets, that might overwhelm their ability to respond and thus a crisis.
But that's not your base case.
No, that I can't. I
Yeah.
just worry
Yeah.
we're going down that path given where valuations are and where they seem to be headed.
Okay. Well, you're still sanguine, like you said. A little more cautiously
Yeah.
optimistic, I would say, since the last time I spoke with you in the summer. But good update nonetheless. Where can we study your work, learn more from you?
Yeah, you can see it on Economic View. That's a website that we have where I put up all my content, and you can. There's a lot of stuff, other stuff going on that website that you might find of value. Folks that are listening in here might find of value.
Okay. Fantastic. Thank you very much, Mark. Speak next time.
Anytime, David. It was a great pleasure to chat with you, and look forward to the next conversation.
Absolutely. And follow Mark in the links down below. And thank you for watching. Don't forget to like and subscribe.